Good morning. I'm Gary DeWaal, and this is Bridging the Week for March 20th to 24th, and today is March 27th, 2017. Last week, a broker-dealer was charged by the Financial Industry Regulatory Authority for failing to consider whether suspicious trading by certain direct market access clients that caused it to limit or stop their trading also warranted filing suspicious activity reports with the Financial Crimes Enforcement Network. In addition, stock traders were substantially penalized in Singapore and China for engaging in spoofing-type conduct following first-of-their-kind enforcement activity by local authorities. Finally, Jay Clayton, President Trump's nominee to serve as chairman of the Securities and Exchange Commission, testified before a Senate committee that, if confirmed, he hoped to enhance U.S. capital markets to make them more attractive to potential new issuers, perhaps by reducing regulations. Spring arrived in New York City last week, and subsequently the temperatures dropped to among the coldest temperatures of all winter. So I can have some hot beverages as soon as possible to warm up. Let's get started. Electronic Transaction Clearing Inc., a registered broker-dealer, was charged by the Financial Industry Regulatory Authority for failing to consider whether suspicious activity reports should have been filed with the Financial Crimes Enforcement Network after the firm limited or stopped certain direct market access customers' trading activity. Electronic Transaction Clearing had restricted trading by certain of its customers after 30 instances where the firm identified problematic conduct, including prearranged trades or trading without an apparent economic reason. Clear red flags charged FINRA. However, in connection with these circumstances, Electronic Transaction Clearing did not additionally consider whether to file a SAR, despite also being advised that FINRA enforcement intended to bring charges against the firm for prior incidents of the same type. Red flags and a warning by a regulator. If true, certainly enough to at least be very careful. Dennis Tay Tien Yang, a Malaysian national, was sentenced to 16 weeks imprisonment by a Singapore judge after he previously pleaded guilty to charges that he engaged in spoofing-type conduct involving the trading of contract for differences and their underlying securities between October 2012 and January 8, 2013. According to the Monetary Authority of Singapore, during the relevant time, Mr. Tay placed quote-unquote false orders in the underlying securities listed on the Singapore Exchange in order to influence the prices in the corresponding contracts for differences offered by two investment firms. After executing the contracts for differences, Mr. Tay canceled his orders in the underlying securities. Mr. Tay was charged with alleged offenses following an investigation by the Monetary Authority of Singapore and the Commercial Affairs Department of the Singapore Police Force. This action marked the first criminal enforcement effort by the Singapore authorities related to spoofing. Separately, the China Securities Regulatory Commission sanctioned Hangbo Tang, the equivalent of $36.4 million for engaging in cross-border market manipulation in China using the Stock Connect arrangement between the Hong Kong Exchange and the Shanghai Stock Exchange. According to CSRC, Mr. Tang accomplished his objectives with the assistance of his trader, Tao Wang, by using 3 accounts in Hong Kong and 1 in China to engage in various manipulative practice, including spoofing and wash trading of a stock listed on the Shanghai Exchange. Both Mr. Tang and Mr. Wang are citizens of China. This case was the first enforcement action by CSRC related to cross-border market manipulation. During testimony before the Senate Committee on Banking, Housing, and Urban Affairs last week, Jay Clayton did not describe any specific policies he might implement if confirmed as chairman of the Securities and Exchange Commission, a position he was nominated for by President Trump on January 4th. However, he expressed concern that, quote-unquote, our public capital markets are less attractive to business than in the past, and he promised to pursue improvements to make them more attractive again. In addition, during his testimony, Mr. Clayton suggested that fining companies for law violations may unfairly penalize shareholders and that, quote, individual accountability drives behavior more than corporate accountability, end of quote. And finally, And finally, Oral Valentin Jr., a non-member, agreed to pay a fine of $35,000 to resolve a disciplinary action brought by the Chicago Mercantile Exchange for allegedly receiving non-public information about a pending customer order for a euro-dollar option spread from a registered floor broker and arranging and later executing his own order against the broker's customer order. The CME claimed this constituted a prohibited pre-negotiated non-competitive transaction. The floor broker, Mark Donahue, a CME member, also settled a related disciplinary action by agreeing to pay a fine of $20,000 and serving a 15-day trading suspension. Separately, as previously reported in a special edition of Between Bridges I published last week, Saxo Bank AS, a member firm, agreed to pay an aggregate fine of $190,000 to the Chicago Board of Trade and the Chicago Mercantile Exchange to resolve 2 disciplinary actions against it for the way it liquidated futures positions of its customers that were under margin. According to the exchanges, on multiple dates between October 2014 and March 2015, Saxo employed a liquidation algorithm that automatically entered market orders for the entire amount of an under-margin customer's position. It did so, said the exchanges, without considering market conditions. As a result, claimed the exchanges, on at least 3 occasions on the Chicago Board of Trade and 2 exchanges on the Chicago Mercantile Exchange, the liquidation caused, quote, significant price movements, end of quote. CME Group said that the liquidations were a violation of its prohibitions against entering actionable messages, quote, with intent to disrupt or with reckless disregard for the adverse impact on the orderly conduct of trading or the fair execution of transactions, end of quote. How about fellow customer risk at the FCMs? Well, that's it for this week's edition of Bridging the Week. As always, there is more information in each article and more articles on the article version of Bridging the Week on the website. Check it out. I'm Gary DeWaal. Have a great week, and until the next edition of Bridging the Week, ciao!